Despite various global economic fears, 2019 has been a great year for global listed infrastructure, with the September quarter continuing the climb higher. Global equities in Australian dollar terms were up 4.6% for the quarter, but global listed infrastructure outperformed, with the FTSE Global Core Infrastructure 50/50 Index in Australian dollar terms up 6.5%. Our unhedged fund was up 4.3% for the quarter, which was below the FTSE return. The 1-year return for the fund is now 20.2%. The currency hedged fund wasn't quite so strong, returning 2.5% for the quarter, as it didn't have the benefit of the weaker Australian dollar. The main driver of infrastructure returns over the last year has been the drop in long bond yields around the world as central banks became more accommodating. Infrastructure valuations and stock prices are most sensitive to real long rates, that is, the nominal bond yield less inflation. Our focus is on the differing sensitivities to this real rate for each infrastructure asset. For example, compared to the rest of infrastructure, airports usually have a relatively low sensitivity to real interest rates, as they have an offset in the revenue line that comes with interest rate moves. When real rates fall, economic demand growth reduces along with passenger volumes. In contrast, long rate cycle utilities like US utilities have a very slow pass-through of the interest rates, so a drop in the US long bond yield makes the relatively high and sticky returns look even more attractive. The experience in Australian and European regulated utilities, like fund holding UK water utility Severn Trent, is somewhere in between. Returns on the utility's capital are reset every 5 years, such that interest rates eventually end up being a pass-through into utility bills. Other considerations are the cost of debt and the discount rate that we use in our valuations. We can use these insights to buy or sell positions as the stock prices fluctuate. We do have concerns with the valuations on some of the most interest rate sensitive sectors, such as North American utilities, as we believe that in the long run, interest rates will be higher than where they are today. Our underweight to these stocks has detracted from performance relative to the infrastructure sector. However, stocks in this space that we do own, like Canadian regulated utility Hydro One and US regulated gas stock Atmos, have performed well for the fund. Even with this year's listed infrastructure strength, we continue to see infrastructure assets trading in the direct market at material premiums to where the equivalent assets are priced in the listed market. Our strategy is to invest the fund in core infrastructure assets that possess high barriers to entry and strong strategic positions. These assets are mostly either regulated, subject to long-term contracts, or have been granted long-dated concessions. After a strong start to 2019, we see the sector as being fairly valued overall, but we can still find interesting stock opportunities for the fund to own.